Welcome to the show. I'm Mitch Goldberg. You're watching Be the Boss of Your Money. We're getting started just about 5 o'clock, a little later than I would have liked, but it's one of those days where I'm just going to say better late than never. I was away a couple of days. I just got back from Scottsdale, Arizona yesterday, Sunday at 2 a.m. Got a little sleep on Sunday, went about my day. I am telling you, it is a little jet lag, little travel fatigue, conference. We went on an incredible hike in Echo Canyon in near Scottsdale, and it was just incredible time. And I'm just feeling so good that I went. Something so spiritual about hiking in Arizona. I've heard that before, but until you experience it for yourself, you just don't realize how true that is. You know, the title of today's show is Banking Crisis? Bank stock crisis? What crisis? The stock market is up since Silicon Valley Bank failed on March 10th. That was a Friday. 2 weeks in a row, stocks continue their winning ways. So, we call it a bank crisis. It'll take down the economy, tear the stock market apart. And here we are. The economy so far is doing just fine, hasn't skipped a beat. Stock market is up. Does this move us closer to a recession? I'm on the record for saying yes. If we are going to have a recession, this is definitely not a good thing. There's no guarantee that we do have a recession. It's just that so many people are talking about a slowdown and a recession and a weak economy. And I'm just wondering where you are all seeing that. I mean, some people are around saying, the economy is really bad right now. Things are really tough. I understand that no matter how good the economy is, it's not going to be great for everyone. It's not going to be supportive of everyone. It's always of most people, the masses. But where do you see overall weakness in the economy? Now, we could go into a recession. It could happen, and those who predict it are going to come out and say, you see, I told you so. And if we don't go into recession anytime soon, those who said we're going to bypass one are going to say, I told you so. To me, it's just a bunch of hogwash. It's just a bunch of bullshit because we don't know for sure. My opinion is I could give you more reasons why we head into a recession than we don't. Doesn't mean we're going to have one. And I'll tell you something else. I don't want you to make your lifelong decisions. I don't want you to make decisions that could affect the rest of your life based on just my opinion. That's not what this show is about. It's not what I'm about. We invest for you, a client first. We invest according to your needs, your risk tolerance, your time horizon. We want you to invest in a way that keeps you invested. So if you invest for somebody and they're taking too much risk and they get spooked out of the market or their accounts go down so much that they can't recover or that they sell out of everything at the bottom, that's a mistake because someone like that won't be in the market for the long term to enjoy compounding results over time. As far as I can tell, every bear market has ended with a new bull market that has taken us to fresh new highs. Every recession has ended and turned into a bull market, a economic expansion, economic recovery. Every one of them. I have no reason to believe that this time will be different. It's never different. It is cyclical. I also can tell you that by the time we are officially in a recession, by that time, stocks will have already shown positive performance because stocks trade ahead of time. They trade in advance. I can tell you that stocks can go down 6 months from today. But I could tell you so many things which have nothing to do with anything. It's just opinions. I take information. I process it. I mix it in with my own experiences, my own market knowledge. It doesn't mean that you're going to make a decision that's going to affect your entire retirement that could make you that could help you make. I don't want you making your decision on my opinion about something 30 years from now that could affect your money lasting you for the rest of your life or not lasting you for the rest of your life. That's not what this is about. We follow a process. We invest for the long term in an investment portfolio that you could stick with. So it might not be, a lot of risk. You could be somewhat young, let's say under 50, and you don't want to take that much risk, because if you take too much risk and your account goes down too much for you, it means you sell out. You don't enjoy the power of compounding over time. So just because you're young doesn't mean you take more risk. You have to take the risk that keeps you in the market over time, because time in the market is more important than timing the market, to us anyway. But I think that has been borne out with endless amounts of time and research. I'm going to roll the intro. We're going to talk about how the market did today, what happened. I'll let you know if you missed anything. I'll let you know what we're watching out for. I'll give you a hint. Friday, not this Friday, the following Friday, the first Friday of April, is the jobs numbers. And we do the whole thing again. We get the jobs numbers, we get the inflation numbers, and then in about 2 weeks after that, we get another Fed meeting. It's just the same stuff over and over, and I can assure you that the next jobs report is going to be the most important jobs report ever, just like every one of them before that was the most important one ever, because we love hanging on to the immediacy of results, of news, and we love to make long-term determinations on very short-term events that we often don't even know why the events occurred, that are often subject to revisions, and that often we will not even remember a year later. So let's do the right thing here and make money. Well, I have to make sure I say this right. So let's do the right thing here and make sure we control the things that we can control and let the process take care of itself. Surrender the results. They'll be there. It's just that, can you hang in there? Here's the intro. Good show coming up. All right, listen, while you're watching this, if you have any questions, or if you're watching in the replay, hit me up, ask me any questions that you'd like. I love hearing from you. It's, it is the best part about doing this, when I see your comments, or if you just want to say hello in the comments. Words of encouragement are always appreciated. Questions are always appreciated. I love hearing from you. So don't forget, give us a thumbs up, an applause or a wow, or whatever reaction is available to you, depending on which social media platform you're watching from, because it helps spread the word to the rest of your contacts, of your friends, that you're watching the show. Maybe it's good for them, and it helps get the word out. Plus, I get to see who's out there and who's watching. So give it a thumbs up, whether if you're watching the replay or actually in the live episode. So let's take a look first of how we did for the day. I'm going to go to another screen, pop myself up in the corner. There I am. Okay. So the Dow is up 195 points. It was up more earlier today, but, that's okay. A nice up day. This continues what we saw last week, which was an up week, and the week before last week was an up week. So the title of this is Bank Crisis. What bank crisis? Because the stock market has been up ever since Silicon Valley Bank folded. NASDAQ was off 55 points. S&P was up 6 points. About the NASDAQ has been the standout leader since Silicon Valley Bank failed, since the bank crisis began. So it makes sense that as the worries of the bank crisis start to fade a little bit, that the NASDAQ stocks went up a lot, start to go down a little bit. Because when we started to worry about the bank crisis, it sent interest rates lower. That's good for tech stocks. Typically, it's good for tech stocks. And now we're kind of just like getting out of that worry. So, was the whole bank crisis a tempest in a teapot contained to just bank stocks, which is not a particularly massive part of the S&P 500? Or is the bank stock issue going to spread to other parts of the market? And will it cause recession because banks want to hoard their deposits instead of using your deposits to make loans? They want to hoard your deposits in case other depositors want to take their money out. The banks want to make sure that they're ready for that. So this is tough to tell. It's really tough to tell. It does seem like we got through this a little bit easier than I expected. But then again, the Federal Reserve, the Treasury, FDIC, European bank regulators have all taken steps to shore up confidence in the global banking sector. Oil had a big day back over 70, but actually almost 73. That's because worries that the bank crisis would cause an immediate recession have receded. As we said before, interest rates are up a little bit. Investors threw money into bonds. Now they're taking money out of bonds. And the VIX is down to 20. I mean, the VIX is literally where it was before the bank crisis. So that's what I'm saying. Tempest in a teapot, or better said, what bank crisis are you talking about? You know, a client of mine, and he's a really good friend of mine, we spoke this morning, and we speak regularly. And he said, you know, I just haven't looked at my accounts in like 2 weeks. He said, I don't want to look because of the bank crisis. And I'm like, well, you should look, because the issue is what I told him is if you just looked at your account statement, you wouldn't even know about a bank crisis because the markets are up. This hasn't been that big of a deal unless you're really loaded up in regional bank stocks. And there are those who are loaded up on regional bank stocks, because regional bank stocks have always been considered this polite, gentleman-like, conservative section of the stock market with very slow growth, very steady growth, very durable, steady Eddie dividends, a little dividend growth. It's been a place for conservative money until the last couple of weeks. And then, you know, the whole thing just capitulated or fell apart. I think that'll pass, and then we'll have a better, healthier, stronger banking sector when we do get through this. Every bank crisis we have, and we've had just a few, savings and loan crisis, look what happened in 2008, 2007, 2008. And now every time we go through it, we make the banks a little bit stronger, a little healthier, a little bit more of a strict regulatory environment. We need a strict regulatory environment because if you don't have it, then banks play with your money and they turn their banks into hedge funds. That's what Silicon Valley was. It was a hedge fund. It was basically a carry trade where they would borrow short-term your deposits for very little. So when you put your money in the bank, what you're doing is you're lending the bank money and they're paying you a little bit of interest on it. So it's cheap funding for them. And they take that money and they invest it into securities, or they make loans where they can make a lot more of a percentage, a lot higher rate. And that's great until short-term rates go up and all of a sudden the carry trade doesn't work anymore and banks have problems. They have to sell assets to get out of the carry trade, and the assets they want to sell are down in value because interest rates went up. So they get stuck in this catch-22. They could get away with it if given enough time. But if depositors don't want to give them that time and they take their money out, then the banks are screwed, and they really have no choice but to say, we ran out of money and now there's a bank run and we have to close, be taken over by the FDIC or another institution. That's how it works. Interest rates across the board are moving up. We're almost back to 5%, almost up to 5% in short-term yields. You see the 6-month at 4.84. We were over 5. The 10-year is 3.59. We put the 2-year at 4.08. The 10-year at 3.5. So the inverted yield curve is not nearly as inverted as it was. And that typically is a sign that either we go into recession or that the Fed will have to lower rates. And I want to talk to you about that because this is like the big question of the day. Are we going into a recession or not? All right. So I'll start by saying this. Investors have been very concerned that if we do go into another recession with interest rates at zero, that the Fed wouldn't have any tools to fight off a recession. But now that interest rates on the federal funds rate is about 4.75% to 5%, the Fed does have plenty of room to cut rates, inject liquidity into the economy, into banks. There's plenty now that the Fed could do with interest rates higher. So I'm going to say that's a positive, not a negative. Banks are in much better shape than they were in 2008, 2009. This is not happening because banks bought lousy assets. It's not because they took your deposits and put it all into weird derivative type securities. This is because they just basically had a mismatch between the timing of when their customers would want to make withdrawals and the money that those deposits were invested in. Okay, so that's what that is. In any event, investors are feeling a lot better. Now, some money managers, Wall Street enthusiasts, Wall Street strategists are saying market goes up a little bit. If the market goes up a little bit more, sell it'll take some off the table because we're going to go back down again. I think it's very short-term thinking. I think now is the time to latch on to certain companies, certain stocks, right? Or stocks of certain companies, and give them time to work. Take advantage of the drop, but do some buying, I think, and let things work. Every crisis and every remedy to a crisis, from the savings and loan, that's when I got into the business, the savings and loan crisis, to whatever calamity you could think of, there was always an antidote to it. There's always a new program, a new cure. And stocks have always recovered. So I know there are a lot of you, I know this, there are a lot of you who are worried about your retirement. You're worried about what's going to happen to your money. You're thinking, why didn't I sell everything 3 months ago, 6 months ago, a year ago? If you knew that, if we all knew that, we'd all be billionaires. We don't know that, which is why you invest based on personal finance, time horizon, your financial goals, risk tolerance. Okay. So that's why we don't just go all cash or all invested in stocks. You follow me? That's why we do things. We make changes gradually. All right. I'm telling you, watch the show again if you need help with this, because I think it gave you some nuggets. All right. It's tax season. What you should be asking your CPA if you got a refund. If you got a tax refund. There's a reason why you get a tax refund. It's because you paid too much in taxes during the year. So the IRS or the state has to send you back money. I'm not saying it's a bad thing. Unlike every other financial advisor in the world who will tell you it's a bad thing, I'm not going to tell you that. What it is, it means you're giving the government, state or federal government, an interest-free loan. If you pay them too much, they'll give you the overage back, but they're not going to pay you interest on it. All right, how much interest could it be? For most people, it's not really meaningful. And so I can't say when someone in my position goes, "Oh, you're giving the government an interest-free loan, how terrible." Okay, calm down, big guy, all right? It's not that big of a deal. The idea is that people like to get refunds because it gets them used to living on a certain amount of money every pay period, every month, every quarter, every year. And the extra money, or the money they get back, is the money that they learned how to live without. So they get it back and they think of it as a bonus or extra money, and they use it to fund a vacation, a retirement plan, whatever it is. If that's what people need to do in order to not spend every penny they earn, then I'm actually all for it. And I'm probably the only financial advisor in social media to tell you that. We like to say pay yourself first. So if you make a certain amount of money and you take out a little bit every pay period before your money hits your checking account from a direct deposit, and you send a little bit of money to a retirement plan, you learn how to live without that money that you sent to the retirement plan. It's a similar concept with getting a tax refund. Now, if you don't want the tax refund and you want to get more money every pay period, you need to speak to your accountant about how to change your W-4 form, raise your dependents, claims, things like that. And it's easy to do. Most people get a W-4 form and they have no idea how to fill it out, and their eyes glaze over. So they do nothing, and therefore very little in taxes are taken out. If that's the case, you might actually owe money to the government. And if you do owe money, you will have to pay the interest on that as well. Doesn't work fair, I get it, but that's the way it's going to work. We're not here to fight City Hall. We're just here to be better with our money. So it's up to you if that works or not. So you should talk to your CPA about that. I'm not a tax advisor. I don't give tax advice outside of the scope of taxes are an important part of financial planning and investment advice. Okay. What else? You have to have a portfolio that's right for you. I don't like general statements. Well, if you're 40, you should have an aggressive portfolio. If you're 60, you should have a conservative portfolio. It's the portfolio that's right for you. And sometimes I say almost pretty much, I'm going to say this every time. Having the right portfolio for you is a matter of experience. I could sit here with you and go through all the financial questions, the risk tolerance questionnaires, and help you figure out the right portfolio for you. But until you experience a down market, until you experience losing money, it's a different story. And your risk tolerance might not be as high as you thought. So learning your risk tolerance comes with age, it comes with experience. This is another reason why it's good to get invested when you're younger, so you could learn what your true risk tolerance is when you're not playing with as much money. Okay? So these are the things that I like to talk to people about. I'm going to let you go. That's long enough. I have a few other things to get into, but we're on for 21 minutes, so 22 minutes. Have yourselves a good day. Listen, I'm on the radio every morning. It's called Money in the Morning with Mitch Goldberg on 103.9 FM. If you can't get the radio station where you live on Long Island, then or anywhere you are, just go to the app, LI News Radio app, and you can check it out. And I am posting all of the episodes onto YouTube, and that's a good place to go to as well. Have yourselves a lovely evening, and I look forward to seeing you tomorrow. Thank you for joining me.